So welcome to the last video about the book, and this one is just about appendices, and yeah, I'll just go over them. So I'm only gonna be doing the first one in TradingView because it has a couple of oscillators, like indicators, which could be used, and the rest I'm just gonna do from the book because, well, it shows great explanation, so I won't have to explain everything or speak up everything which is there. So yeah, I'll just go over the first one. So Appendix A, Advanced Technical Indicators. So there are a couple of indicators which are more like advanced. I'm not sure why you didn't put them in like the oscillator book, or why you didn't put them in the oscillator chapter, which I think was 11. But yeah, they're here anyway, so I'll just go over them. So the first one being is the demand index. The demand index is the ratio of buying pressure to selling pressure. So what you can see is this histogram on the bottom. If it's above 0, there's more buying pressure, so the price is likely to go up. If it's below 0, there's less buying pressure or more selling pressure, and the price is likely to go down. And you can see here they had a couple of divergencies and all that stuff. But yeah, so I'll just pick it up and sort of view it with you guys. So you have the demand index right here. It's a community script, but that's fine. Just change the color a bit. So let's do a green. So this is the amount of buying pressure to selling pressure. I'll just zoom out like this. So what you can see in purple, you might not be able to see it, is the 0 line. And whenever the price is above the 0 line, there's a lot of buying pressure. And it doesn't necessarily mean the price will revert, but there's a chance the price will revert. So what you can see right now is the price bottomed out, really. Everyone was selling, but that was at this point, right? And you can still see it actually, there was a really long wick here from 22,900 to 22,100. So even though the price still went down afterwards, still had there's still more selling power. As you can see, there's more buying power coming back now. So I guess it's just an indicator, and I guess it just shows the ratio of buying pressure to selling pressure. So let's go to the next one. Might have zoom out a bit. So which is gonna be the Henrich Payoff Index. This one sadly doesn't work at TradingView, or maybe just didn't get it to work. I'll just try it in a second. But basically, this one is about the. Let me check for a second. Oh yeah, it's about determining the money flow. So it's sort of similar to the demand index, but basically it uses price, volume, and open interest in its calculation. Yeah, so crossings above 0 are buys, and crossings which go below 0 are sells. So I'm not sure what the big difference is between the demand index and the Henrich Payoff Index, but yeah, it's here. And sadly, this one doesn't work in here, but might just Henrich Payoff Index. Sadly, this one doesn't show up here, but I'm not sure why it doesn't. I tried it on different charts as well, but I might just be picking the wrong one. But it's on TradingView. I'm not sure. I'm probably doing something wrong. I'm not gonna dive too deep into it. Now we got Stark bands and Keltner channels. So basically, these things they were like the Bollinger Bands, at least they seemed like. But the Stark Bands deploy or plot a 6-week moving average, and then has like on the upper line is like a market extreme to the top, and on the bottom line is, or the lower line, it's like a market extreme to the bottom. So this one is sort of like buying pressure. They do work on here. So let me just count the Stark Bands and the Keltner channels, which is right here. I'll start with Stark. So basically what you can see if you zoom in really, it sort of creates the market extremes. And it doesn't necessarily mean, for example, right here, that when it reaches below, it's a market extreme and it's not a good time to sell. But as you can see, it's a moving average, so we'll always sort of revert back to the blue line. And especially now in the trend line, you can see clearly this trend is going downward, so it could be a good buying opportunity to go for a short when it touches the green line, and actually it almost never does, but as you can see, it's a market extreme and there is some profit to be made here. So I guess that's what Stark bands do. Didn't really go too deep into it. And then you got the Keltner channels as well. So basically what this does, this is an exponentially moving one. So it takes the candles, 20 candles, and it multiplies it by 2. So it's basically like 40 candles, except it only looks at the last 20. I'm not sure if it makes sense, but that's what it does. So you can see this one is sort of more lagging behind than the Stark bands. But still, this one is there as well. Really shows some market extremes. And I think it showed it with gold. Actually, I already deleted it, I think. Yeah. But yeah, that's pretty much it. I'll just now go over to the book and finish the last things off. But I'll just grab things here and have them together. So this is what basically Appendix B is about market profile. This is kind of an old thing, really. But when there were traders like in a sort of pit, he talks about. So I'm guessing they're on location and doing trades every day. And I'm just imagining some Wall Street office or something. So that's what I got the feeling like what he was talking about. But basically, you got traders there who want to go trade the long term, right? So they want to have the best deal for themselves, and then you got traders on the short term, which could just well, a long term, a long chart has, of course, like intermediate movements and stuff. So even though something might not matter to the long-term trader, it could to the short-term trader. So I guess those are just battling all the time. So let's just get through it. So basically what they use a statistical picture of like the price. So they don't use time. They only use letters for time, but I'll get onto in a second. So basically what you can see here is test scores for like some tests or children, something. And what you can see, the mean and the mean is in the middle at 75. And what you can imagine now is you can just flip it sideways, and you can already see sort of where the price was for the most of the day. And of course, this was the mark which the people got. But let's say the price ranged from 0 to 10, but it stayed at 5 for the longest amount of time, or like it touched it the most times. Then it will be in the middle, will be the longest, because well that's sort of where the equilibrium is forming, which is like the how do you say it, the balance between the price, I think. But yeah, I'll show it here. So basically what happens here, this is still sort of a time frame because they use 1 2 3 4, but what happens is every letter is half an hour. So A, B, C, D, right, all half an hour. So this is 2 hours worth of trading. You can sort of see where the price goes. So this is an up. You don't know like where it opened or where it closed, but you can just see where it went. And basically, yeah. So sorry, here is actually the picture. So you can see what happened here, right? This is basically the same. And here you can see what happened. So candle A stayed in this price range, and when you move to the next half hour, you get B's, right? You get, I'm not sure how they have 4 letters, but I guess just touches. No, never mind. That's fine actually. And then you can move to the next one, C, and you can sort of see an equilibrium forming here. There's actually a balance. It's like still like the same thing, which is sort of the price forming, which was good for the long-term traders and the intermediate trader, or the short-term traders on like the Wall Street office. So let's go into market structure. Oh, and actually, what is important to know, they use capital letters for the first half hour of an hour, and they use, wait, is it correct? There was something with using capital letters and small letters, and I think it was either past noon or it was every no, I think it was past noon you use small letters. I think it was that, but I'm not sure about it. Oh yeah, sorry, midnight to noon. Sorry, yeah, lowercase. Okay. Market profile. So, I'm not sure about these because I wasn't really familiar with these, so I just kind of skipped through it. But you got market profile, principles. So you got an auction setting. the continuous negotiation, the market balance and imbalance, time frames and trader behavior. The short trader and the long-term trader play different roles. They both play key roles, I believe, but they just play different roles. But they both initiate balance, right? And then price and value. So I'm not going too deep into these, but they're there, just sort of to have them. They talk about it, but I don't think I'll use it. But I just know how it works, and that's pretty much it. So this one was kind of interesting to me. It talks about the different kinds of days, so you can see the explanation to them. And here's the picture of like what's happening, and you can't see the letters, but basically, oh, it's hard for me as well. But you can still see the J and the M and the I and the G. I can't even read it, but they basically talk about the days itself. Tracking longer term market activities. Also some pictures with it. Value area, yeah. I just kind of skipped through it because I wasn't too interested in it. I guess it's just there, right? So this one was interesting. The essentials of building a trading system. This one was interesting because I'm also kind of looking into, do I want to build a trading bot and how am I going to do it and stuff. But he talks about a pretty detailed steps and stuff on how to really make it. So why would you use mechanical approach? Of course, you can backtest ideas. So instead of using your money and just throwing it and see what happens, you can actually, all the data in the past, you can use it like from every single market as well. So that's why a good trading strategy should work on a 15-minute trading or 15-minute price range, or sorry, timeline, and also on a 10 years timeline. This is extreme, but it should sort of. You can be more objective and less emotional. Like it's following rules, right? Because humans have emotions, and that's why a lot of people, I think, on Wall Street do cocaine just to keep them sharp. Stuff. It's not just about the movie of Wall Street, but I believe they actually do use a lot of cocaine. Yeah. And of course, you can do more work. Computer can check a whole lot of markets and stuff and do everything. So there's a 5-step plan. In short, it's starting with the concepts, then turn it into objective rules. So let's say you want to use oscillators only. Well, you gotta code those rules. Then you're gonna actually check out the charts and really visually check it out yourself. Like look at it yourself. Does it work and stuff? Because why? Because it worked for him. And I'm not sure what the reason was anymore, but maybe we'll get into it. Then you can backtest with a computer, and then at the end you can evaluate the result and change your concept totally, or just change a bit of rules to your objective rules, right? You can change a whole lot of stuff. So first of all, start with the concept. Principles of good design. These are pretty standard, but basically it must be clear so that it doesn't have to be completely complicated or extremely complicated. But it must work for you. Let the winds run and cut the losses short. Basically, what he talks about. But everything that makes money in the long run is probably a good concept design. So yeah, just something to keep in mind. So there's actually 3 different sort of roads you can go by. So the first one is going to be trend following, which you can use, of course, with like simple moving averages or like any moving averages at all. But basically, it's trend following. So it looks at like the X amount of candles back and just does something with it. Those can work. You can also combine it or just focus on counter trend. So you can still be in a trend, but let's say there's a market extreme. You can go for a small short, or you go for a small resistance, like maybe 33%. But the thing is, you don't know if the price will go up, and then you'll lose a lot of money. So it's kind of more on the dangerous side. But at the same time, if it's a real market extreme, you can the bot can make quite a lot of money as well. So of course you have support, resistance, retracement, and oscillators. And the last one is going to be pattern recognition. And this one is about probably about what comes to my mind, at least, looking at candles, and do you see like an engulfing pattern or something, right? So those patterns. But you can also just look at, is there a head and shoulders? Is there a double top or double bottom, or like even a triple top maybe? Like those patterns you can also follow. Now the second step, turn your ID into a set of objective rules. Of course, this is small step, speaks for itself, but the thing is you really need to make your own. And I could think that's also a great learning experience as well if you just make your own. Now here it talks about visually checking out the chart. You sort of want to prove that it works. And the thing is, right now with computers, especially with TradingView and all that stuff, it's much easier to really backtest a lot of stuff. But I'm not sure how I would backtest my own strategy. So that might be something I have to visually check out. So, but I'm not sure. I'll actually have to go into it. I might make a series out of it. This one is about the formally tested with a computer, and basically here he talks about how you should test it. So here he talks about maybe your standard form is 50 to 20 moving average crossover, but it should work on 16 to 18 or 5 to 19 as well, right? So also check things out because it might just as well be a coincidence. You really want to filter those things out. And here he talks about his code and some easy language code, but like never heard of it. I don't think people even use this anymore, but it's there. Yeah, so different periods of time. So instead of having the time frame different or the moving average different, have the time frame different. So like a 5-year period or a 20-year period or the past 20 years or the 1960 to 1980, right? Just change things. And as well, changing the market is an important one as well. And last one is evaluate your result. And it's a pretty good rule of thumb for every dollar you lose, you at least want to make a bit more than $1. And I think, or at least he mentions, a good objective is earning $2 for every one lost. That's a pretty good rule. Because there's also some transaction fees and what did he call it again? Maybe it's slacking? I'm sure what it was. Was something. Yeah, so basically he talks about profit factors, the average trade win and loss, the max interest intraday drawdown. Yeah, almost done actually. I'm not sure what to say about these, but just if I have the results clearly. And then money management, also an important one. And he talks about diversify your bot because, well, you probably don't want to have it in one market only. It's probably better to just diversify it. And the thing is, if you're just using crypto, you might just want to focus on Bitcoin because, at least from my experience, from what I have seen, a lot of coins just follow Bitcoin. And when Bitcoin dips 1%, the altcoins go 5%. And it's not always that case, but it's just you'd rarely ever see a crypto or an altcoin going positive whenever Bitcoin is going negative. And not like a 0.5% negative, like 2%, 4% negative. Like every other crypto is down. Like literally even the stable coins. So just, keep that in mind. Then there's one more, I believe. Yeah, so the last one, continuous futures contracts. And, well, I actually didn't dig too deep into these, but I'm just stating what there is. So we got the nearest contract, which 15 to 30 days before expiration is actually going to go and look for a new contract. And I'm not sure if it's automatically or people actually go there. I'm not sure. I think they call it a rollover period. Then you got a next contract. Just reading with you. So it's your unique offspring of the nearest contract. It's exactly same as the nearest contract, except that it always always follow the nearest contract. Not sure if these rules apply. You got the GAN contract, the continuous contract, which is a lot like the perpetual contract, and you got the constant forward continuous contract, which basically, this one I actually looked into it because, of course, whenever I trade Bitcoin on like any sort of exchange, you're using perpetual contracts. So what happens is you take two contracts, 2 to 4, and you take the price as it is right now and extend it to whatever period it's sort of aimed at. And of course, this person is not talking about crypto, but he's talking, for example, like corn. So they're just extending the line, sort of. It's a linear line. So that's basically how the constant forward continuous contract works. So yeah, that's pretty much it. And this was actually the book. So yeah, there's a couple of glossaries, but yeah, these words don't really, you can look them up on the internet yourself, but it's not like there's anything spectacular in here. But basically, this was the book itself. I might make a series out of the trading bot and live action trades. So